We all know that real estate has created more millionaires than any other industry on the planet. We also know that it has created a lot of heartache due to mismanagement, overborrowing, and just simple life events that happen to all of us. Welcome to the Cash Flow Pro podcast. My name is Casey Brown, and I am your fearless leader. And although we might be bourbon sipping and at times foul-mouthed Southerners, we will always do our best to be honest, straightforward, and due diligent with all of the information we pass along to you. Welcome to the show. Hey there, and welcome to today's episode of Cash Flow Pro, your daily real estate investing podcast and YouTube channel. I'm here today with Zach Haptonstall of Rise 48. And I had the pleasure a couple weeks ago hearing Zach speak to our mastermind group. We were all in there just listening to the nuggets that he dropped on how to raise capital, where he's finding investors, how he's doing what he's doing. Because let me tell you, 2019, this man, February of 2019, no, let's go back. January of 2019, this guy owned nothing, zero. And February 2019, he closed on his first deal. I just saw when he and I were sitting here talking, I was looking on Facebook. I saw a picture of he and his wife in front of the first deal. I also was fortunate enough to find a picture of the finished product of the first deal. And Zach, dude, killing it, man. Tell us what's going on. How are you today?
Yeah, thanks so much, Case, for having me on the show, man. Really appreciate it, and look forward to providing some value to your investors. And yeah, like you said, we've just been, very fortunate and just focused here in the Phoenix market as far as, multifamily value add syndication. Like you said, we bought our first deal February of 19, and then just have really been fortunate to kind of catch that momentum and scale from there. So we're just solely focused on the value add multifamily here in Phoenix.
Awesome, dude. Well, we're certainly glad to have you here. And I want to point out, I was actually in Scottsdale about 6 months ago. And we were in, I guess, Phoenix, Scottsdale. It's kind of maybe all one area.
Yeah, it's all part of the same metro. You're right. Yeah.
Anyway, we were over in Old Scottsdale having cocktails. We had cocktail hour like all day.
Nice.
And of course, my wandering real estate eye, that is.
Yeah.
I saw like there was just even in a place that's as hot, such a hotbed of activity, there was like, dude, there was opportunity everywhere there. Like it's the weirdest thing. And the only thing that I could come up with, and this is kind of how I envisioned this going about like 100 years ago, right? So these people are traipsing across the desert. They're hot, they're tired, they're thirsty, they're everything. And they were like, hell, let's just stop right here and start a city. Let's start a city in Phoenix.
In the middle of the desert. That's right. Yeah.
And it's like you look out and there's nothing there. Right. Nothing. And so it really, and then to kind of pancake on top over the years, the idea that Phoenix, and I grew up in Colorado Springs, so there was a lot of Phoenixites that would come back and forth. It's like people would get tired of Colorado, they move back to Phoenix. They get tired of Phoenix.
That's where my dad is from. My whole dad's side of the family. So I actually lived in the Springs for about.
Oh wow, interesting. We'll talk about more of that after we get off. I'd be curious to hear. And so I was like, all right, so there has to be something great about Phoenix. So my first time there was 6 months ago, or back in November, but dude, opportunity everywhere. And then like on top of that, you've got Bitcoin billionaire 19-year-old kids who are driving around in McLarens and just zipping in Lamborghinis. And I was just like, dude, I felt like I was in a different country.
Yeah. Yeah, no, you're right. It's crazy. I mean, I was born and raised in Phoenix, so I lived here my whole life. And I mean, even in the last 5 years alone, it's just grown so much. And it's such a large market. Casey, most people don't realize how big the Phoenix market is. It's actually the 5th most populous city in the entire United States. The only cities that have more people than Phoenix now are Los Angeles, New York City, Chicago, and Houston. Phoenix is number 5 for most people in the country, and it's actually growing faster than anywhere in the entire country for 5 consecutive years, according to US Census Bureau. So you just got all these people who continue to come here. You have all these jobs, all these companies, people are making really good money. And then there's not enough housing for all the people. They cannot build fast enough for all the people. And this has been an issue for several years here in Phoenix, always, undersupplied for housing. Ever since COVID, it's accelerated significantly. So you've got all these fundamentals that have resulted in, recent, very strong growth the last 5 years, but also has positioned it long term to be a very stable and insulated market.
Man, and that's the thing. Now, we all go back, and the only thing, and on my show, it's pretty popular. We always kind of traipse back into 07, 8, 9, 10
Yeah.
ish, that era.
Yep.
And I remember Phoenix, and really, honestly, man, I remember the .com bust back in like 2000, 2001. And like Phoenix was a desert town at a couple of those junctures. And that has to, I know 07, 08, 9, 10 has been 13 or 14 years ago, but we're not that far separated from that in order to comfort investors and have investors understand that, man, listen, we were built on our city was built on some type of now we're building on rock instead of building on sand, I guess is what I'm trying to get at, as far as like the it seems like it's a lot more sturdy now as far as income and companies that are actually looking to relocate their businesses there, and that the
Right.
workforce is there. And something that really resonated with me when I was there, again, I keep going back, and me being there is not what this episode needs to be about, but something kept resonating with me, and it was like, even when you got down to the waiters and the waitresses at restaurants, everybody had a very solid common goal. It seemed like they were very educated. Nothing was sloppy about anything we did there. And I
Right.
was so ultra impressed with the classiness that the area presented itself in.
Yeah.
Was I maybe just over exuberant about being there, or do you think that that's something that stands out to a lot of people?
Yeah, no, it's a great question. Great question, Casey. And yeah, I mean, like you said, in 2008, 2009, I mean, there's the negative, perception, or one of the big criticisms of Phoenix is that, oh, well, people say that was a boom or bust market in 08, 09. And what most people don't realize is that, yes, single family homes did very poorly in Phoenix in 08, 09, as they did across the country. But, affordable multifamily, these class B assets where the bulk of the demographic lives that we focus on, they actually, we're pretty resilient during that time, because when people lose their single family homes and they can't afford those luxury class A apartments, they all trickle down into these types of apartment buildings. Okay. So they're very resilient. And one of the big issues, to your point, in 08, 09 was the employment base. The employment was heavily concentrated in construction jobs. And whenever there's an economic downturn or recession, those construction jobs just dry up. They go elsewhere. Well, now you have a completely different economy. It's so much more diverse, so dynamic. You've got, financial services, healthcare, tech jobs, trade, transportation. So you've got this extremely insulated and diversified economy now, where, I mean, the closest thing that we've had, I mean, obviously looks like we're going into an economic recession now, which is solely, been driven by supply chain issues and inflation, and raising interest rates at the Fed. But, the closest thing we've had in recent times prior to this was COVID-19, right?
Yep.
Well, Phoenix had the lowest job loss rate in the entire country as a result of COVID-19. Not only did our apartments not see any negative impact, we actually saw significant growth throughout COVID, because more and more people are coming. Primarily, the data is showing from California, Washington State, New York, New Jersey, Chicago. They're coming from these high tax, high cost of living places. They're coming to Phoenix, which has such strong job growth. They might be making the same, if not more money they were making before, but they're living in a lower cost of living, lower tax environment. And it's a better quality of life overall. And then you mentioned the people. And so it actually is well documented the last several years. just the talent pool of the workforce in Phoenix, and that there are a lot of educated people here. There's a lot of people that, you know, are coming here from different places because they see the opportunity, right? And because it's lower density, lower cost of living, you get a lot more bang for your buck as compared to like California, for example, or Washington State, or some of these East Coast high tax cities. And so, yeah, I mean, it's you look at these markets across the country. You've got like Arizona, Texas, Florida, the Sun Belt. You know, you've got kind of Utah, Idaho. So you got these states that people are all kind of flooding into. The difference is that, you know, Phoenix is larger than any of those markets besides Houston, okay, that we talked about. So it really is the Mecca. And I think historically it's not gotten a lot of attention because you're right. It's just the perception is, oh, it's like a desert. There's a bunch of cowboys out there. No, it's fully, it's a fully developed city. Trust me, it's one of the biggest metros in the entire country. When we say the Phoenix Metro, we're talking about at least 15 or 20 different cities all in this one metro. Okay, so we own deals in 5 different cities in the metro: Phoenix, Scottsdale, Mesa, Glendale, Tempe. You know, Tempe is where Arizona State University is, which is probably like 5-10 minutes south from where you were when you were there, Casey. So yeah, I mean, it's this massive market that just continues to grow. And unlike these other big markets in the country, the Phoenix Metro is not geographically landlocked. Okay, it continues to grow further and further out into the southwest and southeast, literally into the desert. Okay, so all these companies keep coming here. I mean, you name some of these big companies. Go ahead, Casey.
Well, I was just going to say that the other the part of that I didn't mention about these guys just stopping in the middle of the desert saying, "Huh, let's put a city here," is the fact that there is essentially almost enough area for infinite growth. I mean, obviously everything has its limits, so using the word infinite in anything is not wise. But I'm just saying it can just continue to grow. It's like, and everything is square, like you know, your blocks, your streets, everything
it's on a grid. It's on a grid.
It was, man, I don't know. I'm touting the Phoenix market, and I know that that's what drives the idea that a lot of people want to invest there, is simply because of everything that we're discussing. And you know, there was a few little foothills off. I don't even remember what direction we were headed, but there was a few foothills that were kind of right outside the city, and not to mention, you know, they do a really good job with professional sports. I mean, so that's a big draw too. And so anyway, man, I you know, with that being said, I want to reverse back just a little bit and talk about your first deal. Like,
sure.
And was your first deal, was it a syndication? And if so, was it a B or a 506B, 506C? What did the framework of that look like? Because a lot of people listening could either be beginning capital raisers or even beginning investors that want to know like how things get started and where this kind of stuff comes from.
Yeah, great question, Casey. So, you know, when I started, to give people context, I had no background, no experience, not only in multifamily, but in real estate, period. I don't have no family connections, no rich uncle. I just came from like a lower middle class, normal family, right? My parents have W-2 jobs, you know, making average wages. And so, so I had no idea what I was doing. I quit my job in January 2018, lived off of savings for over a year before we even closed on the first deal. And it took 10 months from when I quit the job, just doing this full time, to actually get the first deal under contract. And so the idea and the strategy was to try to syndicate the deal. Okay. So it was my partner and I, Robert, you know, we tied the deal up. We each put 25K of non-refundable earnest money up. And it was a 36 unit deal, about 3.4 million purchase price. We needed to bring about 1.4 million of total equity. And the plan was to syndicate it, right? We've been talking to people in the previous months and they're all saying they're interested. Well, you know, once you got, you know, what I like to call live bullets and you're under contract and it's time to go, now it's game on, and all those people disappeared. I reached out to them and I'm like, hey, you're not getting back to me. Like, oh crap, our earnest money is non-refundable. The money's not coming in. And when you're starting out, you don't have a track record. I don't blame those people for not investing with us, you know? So it's a grind. It's never like from the outside, when people see people on podcasts or social media posts, they think, oh, that person is so successful, they've got it together. It's a grind, man. And it's always very scary. And obviously we've been fortunate to be more efficient and execute and build a track record. But in the beginning, especially, you have to bootstrap it. And so I had about 165K of cash left in my savings. I put 160K of that into the deal. So I was all in. And my thinking was, first off, I need to eat up this 1.4 chunk. I need to get it down to zero to close. And second, if I put a big chunk of my own money in, I'm hoping I can attract other people by showing them I have significant skin in the game.
Yeah.
My partner Robert, yeah. So I was like, I wanted to tell people I'm all in. I believe in the deal. Let's go. Robert put 275 in. Fortunately, by the grace of God, I found a 1031 exchange. Somebody was selling a 12-unit deal in Seattle, and they had about 650K coming out of the 1031. And so we brought them in and actually did a tenant in common, or a TIC structure, which I had no clue what that even was until that point. I had never even heard of it. Okay.
But that gives him direct ownership of a share of.
That's right. Yeah. You can bring in an exchange, and we have these what are called tenant in common, which stands for TIC. You have different TIC LLCs. So I had a TIC LLC, Robert had one, and we had this 1031 exchange. So there's 3 TIC entities. And I met our third partner at Rise 48, Bikron. I met him while we were in escrow and somehow talked him into putting 150K in. So I got him in, weaseled him into the deal. and then we found a couple other people to round it off. So yeah, we did not syndicate it. It was just a handful of us putting in our own big chunks of money to get the deal done. And it was a very, long, stressful escrow.
Sorry. So I want to pause real quick because there's a couple of elements of this I want to pluck out so that we can get a little more depth on. Yeah. The first part of it is, so if it's a tenant in common structure, that is an alternate or basically a different way to raise equity for a deal and that makes it not a syndication, correct?
That's correct. Yeah. I mean, there are such things as what's called a TIC syndication. You can do that as well. But what we did was no syndication, meaning we had no passive investors. Everybody in the deal was considered active. And the rules of a TIC agreement, and I'll give the disclaimer, I'm not an attorney, consult your attorney, but we've done some of these now, so I'm pretty familiar with them, is that each of the tenant in common entities, or the TICs, so to speak, have to have unanimous voting rights. Okay. So let's say Casey and I want to go buy a deal, and Casey, it's $1 million equity raise. Casey puts in 900K. I put in 100K. Well, Casey's going to own 90% of the deal, and I'm going to own 10% of the deal. But for voting purposes, we're unanimous. Okay. No matter what. And so if we don't agree, then you're going to have problems. Okay. So you have to make sure whoever you're, quote unquote, getting in bed with, you have a good relationship and you see eye to eye, because if I want to sell and Casey doesn't want to sell, we don't sell, and vice versa. And so you have to have, with the TIC, you have unanimous voting rights. And the cool thing about the TIC structure is that you can efficiently 1031 exchange into it and 1031 exchange out of it. Okay. So for example, we brought in one 1031 exchange, that was one TIC, and we just put 2 other entities together with cash in them for the other 2 TICs. Well, when we sold, the 2 of us, the 2 TICs did not 1031 because we wanted liquidity. We cashed out, and the other TIC did do a 1031 out. So you can use the 1031 exchange to bring in bigger chunks of money to do the TICs. You can also do what's called a TIC syndication, where you have.
I was getting ready to ask my next question.
Yeah, and we've now done a few of those. And so basically, how it works is we just closed the deal a couple of weeks ago. I'll give you an example. We sold 2 properties recently. We recently sold 2 different syndications, right? Just a one LLC syndication, hundreds of passive investors. And upon the sale, we 1031 exchange both of them into this larger deal so that our investors can deploy their capital gains tax, and they have the option to participate. And then for that larger deal, as part of the 1031 exchange criteria or requirements, you have to always be buying a larger deal than what you sold, right? So there's always a delta of fresh new equity you need to bring in. And so we had two 1031s that are coming in, buying the property directly. So the 1031, that entity that sold the first property has to own the replacement property directly. It cannot own shares of another entity. Okay, it has to own the property directly. That's why it creates a tenant in common. So you have these 2 entities owning this property directly that have been 1031 exchanged. Then we form a third new entity, which is where we're raising all the new money from outside investors. And that becomes the third tenant in common. So you got 3 tenant in commons. And the reason we do it and feel comfortable from a syndication perspective is because we control all the TIC entities, right? So we're not worried about some outside person.
Having a unanimous vote.
Exactly, unanimous voting. I mean, all of our investors are passive investors in these entities. We are managers of all of them, and we control that. And so, that's why we feel comfortable doing that. So we've done, variations of those. But yeah, I mean, it's a good strategy, especially if you have a first deal and you can find one big chunk of equity, you just have to understand that, with the unanimous voting right rules, and by taking a big chunk of equity from any investor, there's always strings attached, right? So you need to make sure you feel comfortable with them, and you have a good working relationship.
Yeah, and so the second, all right, now I'm going to pluck a couple things out of that to dive into. Um, the second question from the original plucking that I did here,
Sure.
where did you? So you are in Phoenix.
Yeah.
How did you come across an investor or somebody doing a 1031 in Seattle? Was it random calling? Was it?
Yeah, good question. Yeah, so it was through conferences. So I started going to conferences in Dallas, and then I joined a mentorship group based out of Dallas, kind of like you have a mentorship group, Casey. So I joined a mentorship group. That's actually where I met Robert. Was in a conference in Dallas. We both happen to live in Phoenix, and we met each other in Dallas. Like, hey, you live in Phoenix, me too. We're both trying to do the same thing. Let's partner up. And then I met this 1031 exchange investor through that group. And then I also met Bikron, our third partner now. Robert Bikron and I met through this group. And this didn't all happen overnight, Casey. This was
Sure.
a long process. I probably quote unquote dated 7 or 8 different business partners before this point, because you're meeting people, you're like saying, oh, you want to do this? Let's try to work together. Let's underwrite deals. And you start to find, people that work, people that don't work, complementary skill sets, things like that. So it takes time. But yeah, I mean, if you're trying to find not only investors, but business partners, you have to really get out there, and there's obviously a lot of virtual group meetings now, which are okay. I mean, they're not bad. I don't like them, honestly, because I like to just get out there and meet people. But you can get value of those. But I think if you can go to in-person meetups, you can start flying to conferences, meeting people, you're going to find like-minded people.
Yeah.
Because when you're trying to do this, what I found, Casey, was that I like self-educated myself like the first 3 to 6 months, right? Like not knowing anybody in the industry, same as you, right? You and I are the same. Like we don't have any connections. We just start listening to podcasts, right? Like this one, start reading books and start figuring this thing out. And you start to conceptualize it, kind of like you and I were talking before we started recording here today. And then, I start reaching out to like what I call normal people who don't know about this. And I'm trying to like sell them on it and explain it. And it's like a foreign language. Well, then I start going to these conferences and I'm like, oh my gosh,
it's no longer a foreign language. Everybody's
exactly
speaking the same.
They all understand it. Exactly. It's like like-minded people who are looking for the same thing as you. And it's just like you said, it's going to a foreign country to your home country, and you just feel like you fit in the culture. You can speak the same language. And so, and when you're trying to do these things, you have to be around people who are also trying to do it, because they're going to understand what you're trying to do. And then you can start to find those synergies.
Yep. Yep. And that's exactly right. And there's so many gurus out there. There's so many people. And one thing that really, as I started getting into the business world, um, man, it brings to mind real quick the people out there who are trying to monopolize their relationships in a way, or capitalize on their relationships in a way by selling it back to everybody else. It's like nobody, with a lot of different industries, nobody will tell you anything about that industry, but you pay them, they'll teach you all about it.
Right.
And so, and that was one of my big, the annoyance factors when I first started coming in. Cause I was like, man, this is I mean, is it really that difficult for somebody to just say, hey man, check that out over there. They'll help you out. And once I started getting with those people at the conferences and starting to figure out, okay, hey, this is the language these guys talk. Once they know you're serious, you're in business. I mean, it took me forever to get my first side letter agreement. And that was me telling a guy, hey, I'm going to go to work for you. It's not going to cost you anything. I just want to raise capital.
Yeah. Right.
And once I mentioned my mentor, once I mentioned Hunter Thompson, the guy was like, oh, I'll have that side letter. Wasn't like quite like that, but he was like, I'll have that side letter to you tomorrow by 10 o'clock. And so it was immediate. And I don't even know why. I'm kind of rambling here. I know I'm trying to.
No, yeah, but you're right. When you can find these people with the perceived credibility, it just helps kind of get you in, because there's all these people trying to do it, and so other people are trying to sort through. Are you credible? Are you legitimate? Should I spend time with you? And so you have to kind of, in the beginning, you have to kind of, lend other people's credibility, or kind of draw from their credibility by associating with them, right, to kind of get into it.
Yeah, and those conferences, and that's and again, I feel like we have as an industry, we've got a responsibility to just do nothing more than educate people. And
Right.
that's what I was on. I was on a podcast not long ago with a guy who's the self-directed IRA stuff, and I'm like, dude, if these people just had an education, I'm like, how long has the financial industry kept all this stuff beat down so far that
Right.
people don't realize, hey, they can do these things with their own retirement money. And so anyway, I know again that's quite a bit of rambling. There's a lot of stuff there to unpack and figure out. Hey, find your way, figure it out. But I love the conference talk there because they are so valuable. And again, if it does nothing else, it brings back the idea of just doing something. It
Right.
doesn't, everybody's always worried about not doing anything because they're scared whether it's going to be right or wrong. I got news for you. 90% of what you do is going to be wrong,
Right.
but you have to do the 100% in order to figure out what 10% is right.
Right. Yeah. You got to
So
just jump. You got to jump in there, right, and just be taking action and put yourself out there and push your comfort zone. And going to these events is better than doing nothing, right? And you never know
yeah,
if you'll meet that one person. I've spent over $1,000, $2,000 to go to these conferences. And sometimes I'm like, especially in the early days when I was broke and I had credit card debt trying to make this happen, I was like cringing. I was like, oh my gosh, is this the right decision? Then you have to tell yourself, well, I'm only one relationship away from achieving my goal.
yeah, dude, you nailed it. And that
I don't know who you'll meet.
$650,000 1031 exchange guy, man, that was your
We're done.
unicorn. I mean, he
That's
was
right.
there and ready to go. And again, I've been fortunate in my real estate career to be very, very well educated in 1031 exchanges. So that whole talk resonates with me because I've so many times. And one thing that I've noticed about 1031 exchangees, being the person who's getting ready to do the 1031, is there's always an element of panic within them.
Right. Yeah.
It's like and I've so many times had to stop and say, listen, all we're doing is trying not to pay taxes here. This is not a this it's a timed race, but at the end of the day, if your tax liability is capital gains rate of 20, 21, 22, 23%, and you go out and you overpay by 40% for a property, which of the two would have been the most viable option?
Right.
Okay.
Exactly.
So with that being said, let's slow down
Yeah. Gonna put it in context, right?
and make a decision that's going to be valuable for you in the long run. So anyway, all right, Zach, I don't even know, since we're using a different program, I lost track of time here, but I want to make sure that we stay on time for you, for whatever you've got going on. But what does the future look like right now? How does, obviously,
Yeah.
the ticking up interest rates is a little bit of a challenge. Oh, real quick, before we jump into that, I want to talk key partner real quick, because a lot of people out there, and I know that probably came through relationships and so on, but a lot of people out there are like, okay, how do so I know where to source my capital for the equity. I know where to find the private equity, quote unquote, for the equity portion of it. But then how did you secure the remaining loan or loans,
Right.
whatever it was, for the balance?
Yeah, good question. So yeah, I mean, that's a big part that people don't really talk about. And it's, the bulk of the capital stack is the loan, right? So you have to qualify. And these lenders have a lot of, different thresholds that you have to meet in order to apply and qualify for these loans. And so, you have to have, when you sign on the loan, that's considered called a guarantor, also known as a key principal, right? And so depending on the lender and the size of the loan, you're going to have have at least 50 to 100% of combined net worth among your guarantors. So if Casey and I want to buy a deal and we're the only two signing the loan, we have to provide a personal financial statement to the lender, which shows all of our assets, liabilities, liquidity, cash, et cetera. And we have to have combined net worth equal to 50 to 100% of the loan amount. Okay, so they're going to look at what's your net worth to qualify for this loan. They're not going to just loan millions of dollars to anybody, and especially in the beginning when you don't have experience, it can be more difficult to get those loans, right?
Yeah.
You also have to have a certain percentage of liquidity. You have to have X percent And anywhere, it can be anywhere from, I mean, 10%, 5 to 10% for very large deals, maybe higher for smaller deals of liquidity, meaning cash, stocks, whatever, liquid assets. And the lender is going to ask for that. You have to give them your bank statements the last 90 days, the last 3 years of tax returns. You're going to go through full underwriting, background checks, et cetera. And so, for us, that was really the big value that Robert brought initially. I did not have net worth liquidity. My net worth was like my cash, which was almost 300K. So my net worth was like 300K. Okay. In 2018, 2019. And that was also my liquidity. That was everything. Okay.
Yeah.
I owned a house, but that was about it. And so, Robert had higher net worth, high liquidity, and brought a lot of value in that regard to help us sign on the loan, to kind of satisfy those requirements. And so, there's a lot of sponsors who, maybe, let's say Casey and I are just starting out and we want to buy a deal. We don't meet those thresholds. Well, we can go find somebody who is like a guarantor or a key principal, and you can actually compliantly compensate them somehow for signing on the loan. Okay. You cannot compliantly compensate anybody to raise capital or to do anything like that per the SEC requirements. And I'll give the disclaimer again, I'm not an attorney, right? Consult your attorney. But you are able to, compensate somebody to sign on a loan and basically lend their balance sheet to you. So you have to look at what those lender requirements are. And then you want to look at different provisions too, like recourse versus non-recourse. Everything we've done is non-recourse, meaning that if the property fails and goes bankrupt, the lender cannot come after our personal assets for signing on the loan, right? They're just going to take the property and that's it. And so, yeah, there's different things involved that goes into getting the financing, and your financing and can be anywhere between 60 to 85% of the total purchase price, right? So they are the biggest investor really, and you need to get them secured.
Yeah. And where in that, what type of loan did you use? Just a regular?
Yeah, it was a Freddie Mac small balance loan.
Okay.
Freddie Mac small balance loan. So I think it was a 5-year loan, interest only payments, non-recourse. I think we had around 75% loan to value. And then, pretty attractive prepay penalties. And so, yeah, that was the first loan.
Awesome. Well, that's great, man. I mean, and that's again, those are the portions, like you said, it's not the sexy part. It's not the everybody wants to raise capital and procure relationships and be the big dog on top of the hill, but finding that guy or lady in the back of the room that doesn't care anything about any of the glitz and glamour and that they just want to make money, that have that ability to say, hey, let's go get this 10 million, 20 million, $30 million loan.
Right.
That's the non-sexy part, and I think that's why we don't hear a lot about it.
Yep.
So what does Rise 48, what's on the horizon here? And obviously kudos to you all. I don't know if I mentioned in the beginning, but 1.1 billion AUM, assets under management, since you started in 2019, which basically means you all are, as my grandfather used to say, what is it, kicking asses and taking names, or taking names and kicking asses, or whatever it is. So that's a lot of what you all are doing. So tell us what it looks like and what going forward looks like.
Yeah, great question, Casey. Yes, like you mentioned, I mean, since we started, we've purchased 34 deals, all here in the Phoenix Metro, over $1 billion, about 6,000 units. And I mean, just here in 2022, we've purchased 12 properties, over 2,000 units just in 2022. So we've had, our strongest momentum ever. And we're very bullish on multifamily as an asset class. And we're very bullish on the Phoenix market because the fundamentals, and we're sitting here recording this, third week of June, 2022. Yep. And the fundamentals have never been stronger, okay, for Phoenix multifamily. Population growth, job growth, rent growth, never been stronger. Even in the last several weeks, as the economy is essentially tanking, we've had no problem renovating our units, leasing them up above our projected rents, increasing the value of the asset. So we're very bullish, and our entire portfolio is excelling. We've now gone full cycle, successfully executed the plan, and sold 10 different assets. We're selling one more here in July. So we've sold several of these deals. They've all been home runs for investors. And so we're aggressively pursuing deals. However, with all that said, as we record this, the interest rates have obviously become extremely volatile, right? It was just last week the Fed did a 75 basis point increase, their largest increase in several years. And so, the last 6 to 8 weeks, we've been sending offers like crazy, and we can't even get close to the seller expectations for pricing. Okay. And it's because we're having to assume such a high interest rate by the time we close in 60 to 90 days that the deals don't pencil. We cannot hit our projected investor returns. And it's not that, I mean, people say, well, then our value is going down. Not necessarily, because these
Cap
sellers
rates.
aren't selling them. They're just not selling them. You know what I mean? Like in the model, we can't offer nearly as much. We're at like a 10 to 20% discount from where we were a few months ago in the model, but sellers just aren't selling. You know what I mean? And so, we're seeing a significant slowdown. A few months ago, we had 10 deals under contract. We have just one more. We're going to close here in July. And then that's it. We have nothing else in our pipeline. And so, we're aggressively making offers. We think that it's definitely switched to a buyer's market in the last 2 to 3 months across the country. It's been a seller's market for the last 5+ years. It's all of a sudden a buyer's market. And we're active buyers and active sellers, right?
Sure.
So we've already sold 5 deals this year. We've bought 12. We have one more that we're buying, one more that we're selling. And so, on the selling side, we're not going to list any new properties for sale right now because it doesn't make sense to give a discount due to this, recent.
Well, and let there be a little
right stability.
Let there be a little like everything's going to settle, and financially, human nature, we want answers and we want them now. We don't want to have to, but financial,
Right?
in the big markets, they, and a lot of people don't understand the trading of bonds and the shortness, the long, and the option stuff that's involved there as far as bringing the ability to bring retail money to the market and have it hedged against these kinds of things. Right. And so again, because it's not sexy to talk about that stuff, it's very technical, it's very everything. So let the stuff settle. Let them continue to either pour gas or tame the flame, whatever, and let things settle, then go forward. Don't just want answers now. Let's start, because that's where that's where it becomes an irresponsibility towards your investors, really. If you start making decisions and hell, this thing's never going to turn around, don't say it's never going to turn around till you're 2 or 3 years into a bear market. I mean, then then you might have some of those it's never going to change, never going to change mentality. So hi, this is Casey Brown, host of the Cash Flow Pro podcast and YouTube channel. Have you been thinking about investing in real estate but just don't know where to begin? I'd like to help by inviting you to check out our website at www.3000capital.com. There you will find an array of material that will help you learn all about real estate syndication. And while you're there, be sure to check out our free video series download titled 5 Must-Know Keys to Success in Passive Real Estate Investing. I'd also like to personally thank you for making Cash Flow Pro part of your day. Now, back to the show. Well, listen, Zach, we're getting towards the end of our time here, and we have a couple of questions we ask everybody that comes on the show. There's no right or wrong answer, but the first of those questions is, what is the best book that you have either recently read or are currently reading?
Yeah, so there's a couple books by the same author, and I do audiobooks, and I mostly I listen to these every weekend while I'm working out. Both are by Tim Grover, called Relentless and Winning. Tim Grover was the former personal trainer for Michael Jordan and Kobe Bryant. And so I really like, his mindset, and I try to adopt that myself and apply it, to our business. And it's really just about, being mentally tough and, just relentlessly attacking your goals, and trying to be elite. And so I really like those books. So I'd recommend those. Relentless and Winning by Tim Grover are a couple that I'm listening literally every weekend for like the last several months. I just listen to different chapters over and over.
Man, that's great. One of the Michael Jordanisms. I actually met Michael back in 96, 97. I met him 2 different times. Very 96, cool. 97, right in the middle of his awesome. Runs, right in the middle of both of those runs those years. Right. One thing that I remember very vividly is his number 23. His brother was number 45, and he picked the number 23 because he hoped someday to be half as good as his brother. And I've always thought that was very interesting, that he became probably a million, trillion, zillion times better than his brother. But anyway, so next question is, what is a dream vacation that you have either taken or hope to take?
Yeah, so it's funny. I don't really like going on vacation, Casey. I'm honestly not a vacation guy. We went to Hawaii. Grace, my wife and I went to Hawaii a few weeks ago, and we had postponed this for like a year and a half. We've been so busy. Twice we actually canceled it. So some people are going to think I'm a jerk, not a good guy. But honestly, I don't like vacation because I'm so excited and passionate about like what we're doing right now. And I'm always go, go, go. I just can't, I can't stop. I get anxious. I don't like to relax. I would rather just be relentlessly attacking my goals. And so I was actually unhappy, very unhappy on the vacation. And I even told her, I said, I think Hawaii is the most overrated place in the United States because it's just, I'm not like a beach guy. So it's like, so yeah, honestly, I don't want to do a vacation. I think like July 4th is coming up, and I said, we're just going to stay home for this 3 week, and that'll probably be a good vacation. Just kind of hang out.
Yeah. Sometimes just disconnecting.
Right.
If you don't do anything else, just decompress and disconnect. One thing I would encourage you is you sound a lot like myself, and I really didn't start finding enjoyment in travel and things until I started immersing myself in other cultures, because there is a great big wide world out there, and culture was something that I just really like I said on the podcast not long ago. Some people go for sunshine. Like you said, I could care less about the sun. I could care less about Hawaii. I could care less about anything that has to do with a beach. Send me to, I always say, like Clark Griswold, go knock on somebody's door, go in and just let's watch them cut pasta and have a meal, break bread.
Yeah, no, that's cool. Yeah, and that's good feedback. And we don't have kids. I mean, we
have
like 4 or 5 kids. We want to have like 4 or 5 kids. I'm sure things will change, right?
I've got 5, and
you really? Okay, I'll ask you for some tips.
If you want a little test drive, my friend, anytime. All you have to do is all you got to do is say the word. You're gonna meet one of them this weekend. We're at the conference. So, but anyway, well, listen, man, congratulations on everything, brother, and I hope that you all are just continued to be blessed with everything that has been thrust your direction, because it's you all are doing well, and we're definitely always glad to have good success stories, because not everybody gets to have that. So anyway, but man, tell the listeners, if they liked what they've heard, if they want to reach out and get in touch with you, possibly even invest with you all or learn more about Rise 48, how can they do that?
Yeah, I mean, first of all, thanks so much, Case. Thanks for the kind words, for having us on. Really appreciate it, man. Good spending time.
Absolutely, 100%.
Best of luck as well in 3000 Capital. But yeah, I mean, if you want to learn more about us, you can go to our website, rise48equity.com. So rise48equity.com. You can actually set up a call with us if you want to learn more about what we're doing through that website. You can also just email me, Zach, Z-A-C-H, at rise48equity.com, and happy to talk to anybody who's interested and learn more about what we're doing. So appreciate it.
And I will vouch that when you schedule a call with Rise 48, this is the man, at least for now, that you will be talking to.
That's right. You and I, that's right. I called you myself, always.
Absolutely. We always we have a thing in Raise Masters, and Hunter's like, I've talked to Zach about this. I've told him to outsource his investor relations and get somebody on board that can handle these calls. And he said, and anyway, but man, that's great. Everybody has their thing that works, and you know, if it's working, dude, I always said, don't fix a wheel that ain't broke. So
that's right.
But anyway, well, good deal, man. Well, thank you again for being on the show. And listeners, if you liked what you heard today, head down, scroll down, give us a 5-star review, leave a review, and tell us what you thought about the episode and what you think about our podcast. And again, head over, talk to Zach, schedule a call with him. He'll be glad to chat with you and tell you more about his company and more about their strategy. And again, Zach, thank you so much. And I hope everybody has a wonderful rest of the day.
Cashflow Pro is hosted by Casey Brown, founder and CEO of 3000 Capital, a commercial real estate investment firm committed to providing its investors with ongoing cash flow and helping them build long-term wealth. If you enjoyed today's podcast, make sure to hit that subscribe button so you'll be notified about all our future episodes. You can find more information about us and our investment philosophy by clicking the link in the show notes below. Thanks for listening.